Hello, financial enthusiasts! Do you know the common mistakes in stock market investment? Today, we're embarking on a journey to uncover the 6 most frequent blunders that even the most seasoned investors sometimes make. We'll explore the pitfalls of chasing hot stocks, the danger of trying to time the market, the hidden drain of fees and expenses, the perils of investing without a plan, and the risks of letting fear or greed govern our decisions. We'll also delve into the importance of learning from our mistakes rather than repeating them. Each of these points comes with real-life examples to help illustrate just how these missteps can affect your financial journey. By understanding and recognizing these common errors, you'll be better equipped to navigate the tumultuous seas of the stock market. So without further ado, let's dive into these common mistakes. Mistake number 1 that you might be making is chasing hot stocks. This is when you hear about the latest, greatest thing in the stock market, a company that's making headlines and whose stocks are soaring. It's tempting, isn't it, to jump on that bandwagon and ride the wave to riches. But here's the thing about hot stocks. They're often hot for a reason, and that reason might not have anything to do with their long-term viability or their inherent value. Consider this scenario. A trendy tech company is all over the news. Their stock is skyrocketing, and you decide to invest a significant portion of your savings. But have you done your homework? Do you understand the company's business model, their revenue streams, their growth strategy, or their competitive landscape? If the answer is no, you're not investing. You're gambling. Hot stocks can certainly offer substantial returns, but they can also be incredibly volatile. When the hype dies down, these stocks can plummet as quickly as they rose, leaving you with a significant loss. It's essential to understand that investing in hot stocks without analyzing their long-term prospects is a risky move. Remember, never invest in a stock solely based on its current popularity. Instead, make informed decisions based on thorough research and analysis. That's the key to successful investing. The second common mistake is trying to time the market. The stock market, my friends, is as unpredictable as the weather. It's a tumultuous sea of ups and downs, ebbs and flows. Now imagine you're a sailor trying to navigate these rough waters. You see a storm brewing, and in a panic, you drop your sails and abandon ship. But as quick as it came, the storm passes and the sea is calm again. You're left stranded, watching your ship sail away without you. This is what happens when you try to time the market. It's a knee-jerk reaction, driven by fear and panic rather than thoughtful analysis. You see the market dip and you sell. But then, like our storm, the market suddenly rebounds. You're left on the sidelines, regretting that hasty sell-off. And let's not forget, the cost of missing just a few of the best days in the market can be significant. A study by JP Morgan Asset Management showed that if an investor stayed fully invested in the S&P 500 from 1995 to 2014, they would have had a 9.85% annualized return. However, if trading resulted in missing just the 10 best days during that same period, those returns would collapse to 6.1%. The key is to remain calm and refrain from making hasty decisions. As the old adage says, it's not about timing the market, but time in the market that counts. The third pitfall is ignoring fees and expenses. When you're caught up in the excitement of investing, it's easy to overlook the small prints about fees and expenses. But let's not forget, these seemingly insignificant amounts can add up to a considerable sum over time. Let's say you invest in a mutual fund attracted by its promising returns, but you neglect to consider the fees associated with it. Over the years, these fees can slowly but steadily eat into your returns, leaving you with far less than you anticipated. It's like having a leak in your wallet. You might not notice it at first, but over time you'll start to see your money draining away. And it's not just mutual funds. Stocks, ETFs, bonds, they all come with their own set of fees and expenses. Transaction fees, management fees, advisor fees, even taxes. These can all take a bite out of your profits. The key here is to always pay attention to the total cost of your investments, not just the potential returns. Look for low-cost options, negotiate fees where possible, and be mindful of tax implications. Always remember, every dollar you save on fees is a dollar that can be reinvested to generate more returns. So the next time you're about to make an investment, take a moment to consider the costs. Always pay attention to the fees and expenses associated with your investments. The fourth mistake is not having a clear plan. Picture yourself setting off on a road trip without a map or GPS. You have no clue where you're going, and you're just hoping to stumble upon some wonderful hidden gem. But more often than not, you'll just end up lost, frustrated, and possibly even out of gas. The same principle applies when investing in the stock market. It's not enough to just buy stocks and hope for the best. You need to have a clear investment strategy that guides your decisions. This means setting financial goals, understanding your risk tolerance, and deciding how much time you're willing to invest in managing your portfolio. A clear plan also includes diversifying your investments to reduce risk. It's not wise to put all your eggs in one basket, or in this case, all your money in a single stock. A diversified portfolio can help cushion the blow if a particular sector or company takes a hit. Furthermore, a solid plan helps you stay disciplined and focused. The stock market can be volatile and it's easy to get swept up in the moment. But with a plan, you can stay the course and not be swayed by temporary market fluctuations. Remember, a journey of 1,000 miles begins with a single step. And in the world of investing, that first step is developing a clear, comprehensive plan. A plan is essential for successful investing. The fifth common mistake is letting fear or greed dictate your investment decisions. Now, imagine this. You're looking at the performance of a particular stock. It's been on an upward trajectory, and you're tempted to invest more. The fear of missing out on potential gains is real, and it's compelling you to pour more money into this stock. This, my friends, is where fear is taking the driver's seat. On the other hand, greed can be just as dangerous. Say you've made a significant profit from a stock. Instead of recognizing that every stock has its peaks and valleys, you might be tempted to hold on to it with the expectation of endless growth. This is greed in action. In both scenarios, whether driven by fear or greed, you're not making rational decisions based on facts and analysis, but rather, you're being swayed by your emotions. In the world of investing, balance is key. It's crucial to stay grounded, to keep your emotions in check, and to make decisions based on research, analysis, and your long-term financial goals. It's also important to remember that it's okay to take profits and it's okay to cut losses. The stock market is not a game of emotions, but a game of strategy. Stay objective and don't let emotions cloud your judgment. The sixth and final mistake is not learning from past mistakes. Picture yourself at the helm of a ship. If you repeatedly sail into stormy weather, wouldn't you eventually learn to steer clear of the ominous clouds on the horizon? The same principle applies to investing. If you find yourself repeatedly making the same financial blunders, it's crucial to take a step back and reflect on why those decisions didn't pan out as expected. Consider the investor who consistently panic sells during market downturns, only to regret it later when the market rebounds. Or the one who holds on to losing stocks for too long, hoping against hope that they'll bounce back. These are classic examples of actions that lead to losses in the stock market. The key to avoiding these repetitive mistakes is to learn from them, reflect on your decisions, understand what went wrong, and most importantly, figure out how to avoid making the same errors in the future. This could involve honing your investment strategy, seeking expert advice, or simply being more patient and less reactive to market fluctuations. In the world of investing, as in life, mistakes are inevitable. But it's how we learn from these mistakes that truly matters. By reflecting on past decisions, we can gain valuable insights that help us make smarter and more informed investment choices moving forward. Always learn from your mistakes to improve your investment decisions. So, there you have it. 6 common mistakes in stock market investment. We've discussed the dangers of chasing hot stocks, revealing the importance of understanding a company's long-term prospects before investing. We've highlighted the folly of timing the market and the impact of emotional decisions on your investments. We've underscored the importance of not ignoring fees and expenses, as they can significantly eat into your returns. We've emphasized the necessity of having a clear investment plan to avoid aimless investing. We've drawn attention to the pitfalls of letting fear or greed dictate your investment decisions. And finally, we've stressed the crucial need to learn from past mistakes to avoid repeating them. These are vital considerations for anyone involved in stock market investment, whether you're a seasoned pro or a beginner. By avoiding these mistakes, you can make smarter investment decisions. Thank you for watching, and until next time, happy investing.